This episode is brought to you by Tegus, the future of investment research. If you follow my newsletters, you know that Tegus is one of the things I use most often. Almost every post I have has some clip from an expert call or some quote from a management transcript that I've got off BMSEC that, it's because of Tegus that I've got access to all of that. It's revolutionized how I get up to speed on new industries and companies. I've been a happy subscriber of it for over 3 years now. And I tell you, I use probably every day I'm logging on to Tegus to look at an expert call transcript. And I certainly know, my BMSEC, I'm glad that it's unlimited because I am looking at BMSEC all the time. I'm looking at my Google Chrome right now and I have 30 tabs open and I'd say 18 of them are from BMSEC. So between Tegus and BMSEC, I am a very devoted user here. Look, it's one platform where you can dive into expert call transcripts, management checks, panel calls, and detailed financial data. No more fragmented data sources or endless searching. Tegus brings everything together, giving you a crystal clear view of the industries and companies that matter most. If you're ready to supercharge your research, visit tegus.com/value. That's tegus.com/value. Trust me, once you've experienced Tegus, you won't go back to your old way of doing research. All right. Hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on myself. It's time for my annual monthly random ramblings. We're coming around to the end of October, so wanted to get on here and ramble for a little bit. So before I get to the ramblings, I'll just the same way I start every podcast, remind everyone, nothing on this podcast is financial advice. Please consult a financial advisor. That's always true, but probably particularly true today because as it's in the title, I'm going to be rambling. And when I'm rambling, I might talk about a bunch of different things and clearly not financial advice. Please consult a financial advisor. So today I wanted to talk about 4 different things. I'll probably go in depth on 2 and quickly touch on 2 others. And the 4 things are, first, I just want to talk about being in the room with good investors. Then I wanted to talk about geopolitical risks and how they don't seem to impact the stock market too much over the long term. And then quickly wanted to talk about why oil didn't go to 200. And then a little bit of an update on my thinking and numbers rant from last year. So let me start with being in the room with good investors. And I want to start there by telling a story. I am a big basketball fan. Actually, the NBA season, I am taping this, it is October 22nd, and the NBA season tips off tonight. Knicks Celtics is the first game. I'm very excited for it. I'm going to try and go see a few Knicks games this season. I'm a Pelicans fan. I'm going to try and go see a few Pelicans games this season. But I mentioned this because back in 2008, they had what was called the Redeem Team, and they got all of the U.S. I think we didn't even medal in the 2004 Olympics in basketball. Maybe we got the bronze, either didn't medal or got the bronze. And they had the Redeem Team, and they got all the best superstars. LeBron, Kobe, Dwayne Wade, all the best superstars are on this team, right? And everything I hear is all these superstars went, and I believe Jason Kidd was also on the team too. And Jason Kidd is at the tail end of his career, and Kobe is still great, but he's now been in the league for, I think he's drafted in 96, so he's been in the league for about 12 years. He's older at this point. So LeBron, Dwayne Wade, all these young guns come, and the Redeem Team crushes everyone. Actually, I think the game was kind of close versus Spain, if I remember. But the one thing you will hear is LeBron, Dwayne Wade, all these guys, they learn from Jason Kidd and especially Kobe. They learn the power of work ethic, and they all come back. And LeBron, he torches the league in 2009. He's clearly the best player in the league. Dwayne Wade is one of the 3 best players in the league. Like, they really take away and they learn stuff. And you hear all these things, and now you'll hear it when people go on the Olympic team. Especially younger players, they go on and they learn from this absolute peak people, and they're coming back and they're having breakout years because they learn what it takes. They learn how to get better. They get motivated. They push themselves. So why do I mention that? This month I've been to 2, and I think I'm going to another one later where, you kind of semi-conferences where you get 10, 15 investors, good investors in the same room. And there's just something about being in the room. Like, if you go talk one-on-one with a good investor, you will learn something. It will be fun. Yeah, I like to think I talk to them all the time on this podcast. It'll be fun. You will learn something. But there's just something when you get, a critical mass, about 10 investors in a good room. You go, you talk to them, you listen. it really pushes you. At least for me, whenever I'm in the room with a bunch of good investors, I leave and I always think, oh, I've got so much more to work on. There's so many new ideas to work on. There's so much more I can do to hone my craft. And there's just really something to that. So, I think a younger me when I was 20, 25 would have said, oh, these conferences, I'm an extroverted person, but I can be a little in my shell when it comes. And I would have said, these conferences, how silly, how silly everyone goes and sits in a room and listens to one person present on stage. And as you get older, you kind of realize, hey, a Liberty Media Day. The point is not to go listen to Greg Maffei talk one more time about how Q-Rate is going to turn around or how TripAdvisor is going to be great and, it's in a better place than Expedia, and listen to him say that for the, 10th time in 10 years as the stocks inevitably go down. It's to be in the room with really good investors who are really focused in telecom, who are really focused on value investing, who are really focused in media, and to talk to them. It's the breakout sessions, all that. It's not just that you're having fun and you're talking to people. It's that actually really does push you to be a much better investor. And to me, that's where the real fun and that's where the real value in those are. So that's just me. But I was there and I was thinking, every time I leave those, I'm just there's nothing else I want to do but get back to my computer screen and start doing work and start looking at these ideas people pitch and start applying some of the things that people have talked to about there and just become a better investor. So look, that's long-winded, it's a rambling, but that's kind of how I've thought about those conferences. And look, I've said it a few times on these ramblings. Next year, there's a few conferences I'm going to, I want to go to, and everything. I'd love to see people there, and I'd love to continue to kind of build that type of stuff. So, second thing I want to talk about. And this will it's geopolitical risks when I talk about it, and then I want to talk about oil, but they're obviously interconnected. But if you and I were sitting here in kind of early 2022 when Russia invades Ukraine, that would be pretty much the only thing we're talking about, right? Every commodity sector is ripping. You've got, oh my God, you've got literally a nuclear power invading somebody who is on the border of NATO. You've got fears of, is Russia going to use a nuke in Ukraine? You've got all these fears, all these worries. Hey, is this the start of World War III, right? I think the stock market takes a leg down, and 2022 is pretty brutal for stocks for a bunch of different reasons. But, today, I think it would be, we're sitting here 2.5 years later, Russia and Ukraine are still fighting, but I don't think there's anybody who's like, oh, there's a lot of geopolitical risk in stocks right now because of Russia, Ukraine. The stock market has done just fine despite that. And similarly, October 7th last year, absolute tragedy. October 7th happens, and we get a Middle East that is perpetually on the brink of all-out war. Literally, Israel and Iran are sending rockets at each other. And what happens, October 7th, the markets go down. Over the past months, when Iran sends a rocket at Israel, oil prices might be kind of volatile, but again, it's hard for me to sit here and say right now there's a lot of geopolitical risk in the stock market. And again, that's despite pretty much a hot war going on in the Middle East. And you can look historically, America invades Afghanistan, America invades Iraq, wherever you want to go. These geopolitical moves, you tend to get a spike, right when they happen, markets go down, or you tend to get a spike. But then 6 months later, nobody cares. And that's despite, in a lot of these cases, ongoing wars that are very costly, that are very devastating. So I guess my question is, I've heard a few people mentioned to me recently, they're like, look, when you get geopolitical risk, you just buy the dip, right? In 6 months, nobody's going to care about the geopolitical risk. And they would point to all of these examples. And on the one sense, they would be right. Historically, the geopolitical risk has been a buying opportunity. But then in the other sense, I kind of wonder if this is, the turkey before Thanksgiving problem, where for the 1,000 days before Thanksgiving, the turkey thinks that the farmer is his best friend. And then on Thanksgiving Day, the turkey learns otherwise. And I wonder if these geopolitical risks, these dips have been, hey, the market is down because they're worried about contagion. They're worried about the war spreading. And then you kind of recover from that dip as the war does not spread over the next 6 months. And kind of what I wonder there is, yes, they've all been buying opportunities, but it only takes one to be proven wrong. It's a spread. And, I wonder, financial markets are still pretty immature. The wars that I mentioned were really only wars modern wars. I guess we could go back to the Cold War, the Cuban Missile Crisis. I believe stocks were down quite a bit on that day, but they recover. But they're still pretty modern. I do wonder if this buy every dip, if I went even further back, I think buying the dip on the eve of World War I or eve of World War II probably would have worked out for a really long time. And you could go even further back, if you're in the French Empire in the 1800s, if you're in the Roman Empire, right before the collapse, buying the dip there, it turns out to be really bad because the empire's in ruin. So I do wonder if this is Turkey with its head cut off problem, or if geopolitical dips are actually an opportunity to buy. If they really don't matter, the human ingenuity machine moves ever onward. And I guess the counter to that counter argument would be, hey, you buy the dips because there's the famous saying of a guy who it's reported there are Russian missiles in the air during the Cold War. And he sells everything and runs to his boss and said, I sold everything before. And his boss says, are you crazy? Buy as much as you can, because if you buy and you're right and the missiles aren't in the air, then the stocks go up and you make money. And if you buy and you're wrong, well, the missiles are in the air and it's not going to be your problem if the stocks are going down, because there's not going to be a market. So I wonder if you buy geopolitical risk because it's a one-way bet, right? Either the war is contained, there's no contagion, there's no World War III, or the world's not contained and we go to World War III, but we're in a nuclear World War III, so it kind of doesn't matter for you because there's no more financial markets at that point. So that's my rant there. My other rant is, and it is somewhat related. Back in 2021, 2022, there were you'd see the WTI $250 oil bulls, right? And you had people who, partly correctly, were saying, hey, the US and a lot of Western economies, their energy policies have been so insane. They have limited supply so much. There is a oil and energy shortage, and these things are going to go crazy. And you'd hear people calling for oil 250. And look, again, I'm not knocking the thesis. I think a lot of the energy policy has been extremely misguided. And, you could apply the same logic to coal or a lot of other things. But you would hear these huge energy oil bulls calling for 250. And if I was talking to someone we're October 2024, right? If I went to October 2020 and I went to someone and said, hey, over the next 3 years, you're going to have Russia invade Ukraine. And Russia oil is going to get huge sanctions, right? And a lot of their oil industry, whether the sanctions work or not, a lot of the oil industry is going to have a difficult time because just Russia's sanctioned, and they're going to have trouble getting people in. They're going to be cut off from financial markets. They're going to have trouble getting equipment in. So you have that. And then you also have, in October 2024, as you and I are speaking, you're going to have Iran and Israel literally shooting missiles at each other. So you're going to have war in the Middle East. If I had told you that, I think you would have said, oh, yeah, oil 250 is absolutely in play, right? And instead, we've got that. And as I'm speaking, U.S. oil is trading low 70s per barrel. I think if I just am looking at my price chart, right, oil in October of 2021 was in the high, it was touching 80, right? So oil is actually down 10% despite all of these geopolitical risks. And in my mind, somewhat continued misguided energy policy from a lot of the West. And I would just ask, what was wrong? Why didn't oil go to 200? And again, I'm not trying to dunk on anyone. I ask these questions earnestly, not critically. I do think one thing that was missed is markets are very responsive, right? Yes, the U.S. energy policy might be misguided, but as oil prices went up in 2022 in the wake of Russia, they did dial back some of that misguided policy. And oil is ultimately a commodity. There's plenty of it, and people get very good at figuring out ways to retap wells and deliver oil and everything. So I'm sure there's a lot more to it, but it's just one thing that's been on my mind, because I knew a lot of convincing cases that oil was headed a lot higher. And I think geopolitically, you've gotten basically the best of all worlds for that. And oil's actually headed lower over the past 3 years. And I think there's a lesson. I think there's some learnings there. I don't quite know. I have suspicions. I think you heard them. I don't quite know what they are, but it's one thing that I've been thinking about and is really interesting. And look, I subscribe. Bob Rabati is a friend. He came on the podcast. I thought his pitch was great. The revenge of the old economy pitch. It's not just oil and gas where we've underinvested in, right? There's a lot of old world, old economy stuff because of NIMBY, because of a lot of different reasons that aren't getting built. And you catch the cycle correctly, they make incredible supernormal profits. And a lot of these stocks have done very well, but a lot of them also have not done very well. And a lot of them, that cycle still hasn't turned, and the supply demand imbalance still hasn't swung. So it's just something I think about, because I increasingly find myself attracted to hard assets. I think they've, I think there's a lot of places where they've been underinvested, but that type of supply demand imbalance and, financial markets always find a way, or human markets always find a way, commodity markets always find a way. Something I think about there. Last thing I wanted to talk on. Last month in the September ramblings, I kind of did a mention of probabilities. And one of the things I said was, look, if somebody comes on the podcast and they say, I think there's a 60% possibility of XYZ happening, people are willing to give it value. If someone comes on the podcast and say, I think there's a 40% chance of XYZ happening, I just find people are unwilling to give it value. They kind of want it described as a free option, right? Like, hey, I think there's a 40% chance this company gets a $200 million per year windfall. Then they want to pay a fair price for the company and get that 40% chance, which, 200 times 40% is what, 80 million. They want that just as a free call option. They're not willing to pay anything for that. But if it was, hey, the company 60% chance they get 200 million, so 120 million of excess value, a lot of investors, I think, would be like, well, look, I'm paying a fair price for the company and I'm paying $60 million for this free call option. So I get the call option underpriced by 60 million, right? I just find a lot of people work and think that way. I'm, again, not accusing. I completely understand it. I find myself thinking that way sometimes, but numerically it's incorrect. So I mentioned that. And what I realized was I have this great example that I didn't give. So I'll give you the example. And the example is Fannie Mae preferreds. These are, I'll disclose, very small long positions there. Okay. But these are a very popular pitch. I guarantee you, if you go on Value Investors Club, Bill Ackman's pitched them in the past, like, you can find plenty of pitches. So go find them if you want. But I have a friend who, so anyway, right now, the Fannie Mae preferreds are a very popular play on Donald Trump winning the presidency. And the reason is because he has said, I wish I had privatized Fannie Mae during my presidency. And there's a lot of other stuff in it. But, his head of, I can't remember the office, but the office that oversaw it said, I wanted to, he wanted to. There was a appointee in office who Donald Trump couldn't get out of office and replace with his own person in time. And because of that, he couldn't do it during his first term. But a lot of people think he gets back in there, and one of the first things he's going to do is privatize Fannie Mae. And if he does, these preferreds, they could be worth par, they could be worth 50% of the par, who knows? But, I as I'm speaking, I'm looking at one, it trades for about 20% of face value of par. So a lot of people believe Donald Trump gets elected and the preferreds have a shot at par. And, so I've got this friend, and Joe Biden has a terrible debate, and he calls me up, and the Fannie Mae prefers go from about $4 to about $5 per share on that debate, right? And my friend is effusive. He's like, Donald, I'm not bringing politics in this, just to be clear. He says, Joe Biden was a disaster. There's no chance. Donald Trump's going to win. Look at look at Polymarket, look wherever you want. Donald Trump is 60% to win. I think the preferreds are going, let's just make the numbers really easy. I think the preferreds are going to 10 if he wins. So they're trading at 5. There's a 60% chance he wins. They're worth $6. Just the Trump winning piece is worth 10 times 60%, $6. And then there's some sub value if Trump doesn't win. So, these are way undervalued. And actually, the math he was saying was much better than what I just described. I believe his fair value was actually, in the weighted scenarios that he did, his fair value was approaching 10, right? So they were at 5, screaming buy. And then a month later, him and I are catching up, right? And Joe Biden has dropped out of the race, and Kamala Harris has joined, and she's got momentum. The polls are kind of leaning her way a little bit, and I think she's slightly, just ever so slightly. It's basically a coin flip race, right? So let's just say Trump's gone from 60% to 50%, or 65% to 50%, right? My friend and I we're talking, and I mentioned the Fannie Mae prefers to him, and I say, "Oh, look, they've traded from 5 to 4. You must be obviously short-term Marks Hucks, but you've got to love this trade right now, right? Actually, as I'm looking, they traded from 5 to 350. You've got to love this trade because I've got we walk through all your different scenarios, and even if I adjust, it looks interesting." He's like, "Oh no, can't touch this. Kamala's going to win these things." They're headed to 2, right? Kamala wins. These are heading to 1 or 2. Absolutely not. And I was just kind of like, what are you talking about, man? Like, you and I walked through this probability tree. Yeah, Trump's gone from 60 to 50%, but if I update your fair values, the fair value, I said his fair value was 10 at the time. If I kind of update Trump from 60 to 50, your fair value might go from 10 to 8 to 850. That was kind of the rough math I was looking at. Like, yeah, the fair value's down, but the stock's down as much or more. Like, on your probabilities should be better. He's like, nah, come on. And that was the type of thing, right? Like, it went from more likely than not that Trump won to kind of a coin flip, maybe slightly likely than less. And all of a sudden, the probabilities changed, but the price had changed more. And using my friend's probabilities, I thought they looked like a better idea than at the time. Now, look, maybe his fair values have changed. There's lots of other stuff I don't think they had based on our conversation, but it was just one conversation I had with a friend that really jumped out to me, where it's like, hey, the probabilities have changed, the price has changed more, but just because it went from more likely than not to slightly less likely, you're not invested. And the footnotes, the story is, as I am talking October 22nd, Trump is like about 60% to win on Polymarket. And I caught up with my friend, was it yesterday or Friday? I can't remember, but he was like, oh, Fannie Mae's $5 per share. Trump's winning, it's happening. I was like, man, you are really, these 10% swings on Polymarket are really changing what you're doing here. Last thing on Polymarket, there is an interesting story. I can include a link in the show notes, or you can Google it. The Polymarket has gone, despite the polls saying this is a coin toss race, Polymarket has Trump ahead by 60%. And some people have said that's because there's a $30 million whale who's betting on Donald Trump. And, I think there's a quote in the Wall Street Journal article that says, hey, my model says Trump 70% to win. I'm going to buy until he's at 70%. And there's other people, like there was a rumor that Elon Musk was doing this to get better media coverage for Trump and all this sort of stuff. And it's interesting. It is interesting. Like, look, I mentioned my friend who's a sophisticated financial person who is basing a lot of his probabilities, his legal event-driven situations on these Polymarket things. I think financial-minded people, market-driven people like me look at these and say, oh, yeah, like the betting markets are more reliable than polls and everything. So it is interesting. But the one thing that jumped out to me was, I'm a little surprised. Like, there's over $1 billion that's been bet on Polymarket. I have some trouble, and there are other sites as well. I have some trouble believing that $30 million is obviously a lot of money, but just one whale with $30 million betting over the course of weeks could drive probability markets as much as people are saying. Like, if the fair probability is 50, I have trouble believing $30 million bet in that market over a couple of weeks would drive it to 60. Look, $30 million, if you did it in 5 seconds, yeah, that fat finger, that could drive it. But I'm a little skeptical that these markets are so illiquid and inefficient that a check that small could really drive this thing. And, I would say, like, I'm a US citizen. I've not been on Polymarket. I don't know, but there's enough capital, and international markets are deep enough. Like, if it was really 50%, I do think like you'd see some clever traders coming and taking the other side and be like, we got a whale, like we can do it, we can arbit elsewhere, or we can just rely on models. I'm a little suspicious. So I'm just surprised by how much people are taking the story that one whale's driving it. I'd love to learn more. I don't know. I'm not an expert, but I read that Wall Street Journal article and I was like, I'm a little skeptical. But I wanted to relay my friend's probabilities, my thoughts on probabilities. It's something I'm always thinking about. Okay, anyway, so end of October, I've had a lot of fun rambling. Today's ramblings were, what was it? It was good investors and my Olympics analogy, geopolitical risk, oil not going to 200, and thinking numbers. I am looking forward to talking to everyone and rambling a little bit more in November. I am starting to think about I do a yearly state of my empire piece, my podcast, my blog, my premium site, all that. I'm starting to think about how I want the podcast, the blog, and everything to evolve in 2025 in a way where it makes sense for me. I'm getting the best use of my time. Your time that you spend reading and listening, these are valuable in the way that makes the most sense to you. So, I'm always open to feedback. So if you've got constructive criticism, feedback, anything, any ways I can improve, change, all that, I'm very open to it. So all of that out the way, looking forward to chatting in November. I think we've got a great podcast lineup then, and we will go from there. This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's tegus.com/value. Trust me, once you try Tegus, you'll never look back. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.